All right, everybody. How's it going today? Let me check out my mic. Big shout out to the chat. Let's get right into it today. I think I got a little feedback going on. Oh, yeah. Turn that down. What's going on, everyone? And the other thing I want to talk about or get to today, just a quick update on this ape coin that uh, I mentioned last week. I posted a tweet on it, basically defining exactly what's happening with this whole market, folks. Reactions, and that's all you're going to get. Yes, sir. Yes, sir. I appreciated the tweet. It was a retweet, and I appreciate the clip. So the clip was this. Let's play the clip. Let's go to the clip. I'm gonna play it for a second here. This was from about a week ago. A little bit higher, but I will personally come to your house and curse you out if you ride that and don't seize profit at the 886. So, you know, I didn't even know that I was being so dramatic about it, but appreciate that, Lodak. And a shout out to everybody in the chat. What's going on? Hey, Lodak, Arun, Victoria, Neon, thanks. Hey, Miss Stephanie, what's going on? How are you today? You know me. We probably talk more on this stream than I need to be talking to you more on after the stream, but we'll get there. Couple more days, folks, and then I'm going to be back to it in full. So, big shout out. Thank you, everyone. But this is a big takeaway from what we do. Not only did we have the BAM breakout that essentially almost put a double on the move in a course of a week, but the only way we're going to get anything out of this market is an aggressive management style. This is Ape Coin. It could be Dogecoin. It could be whatever coin. It could be Bitcoin. The Bitcoin's not going to do much. At least Bitcoin is holding. Jump over to Bitcoin because it's actually we need to look at total crypto market cap. But again, reactions, reactions, reactions. That's all we have in this the malaise market. That's what it is. How's everybody doing? Shout out on the chat of just give me a okay on the levels. I think we're all set up, all issues taken care of. I'll tell you what, before I get to Bitcoin, the big deal that happened finally was the retest on the total crypto market cap index of our big XA lag 170. What was it? 1715. Okay, 1715. Right there's the XA. That finally hit last week after, coming close and then just sliding, sliding. So, what do we need to see happen here for crypto? Because at least crypto is trying to hold its head. Some kind of confirmation variable. Is it going to be an amplified RSI breakout? There's no HSI, and I'll tell you what, you want to watch here. We want to watch what happens 171 1.71 trillion on the total crypto market cap. We do not want to see this thing roll underneath this, or I'm going to have to reassess. I think, we saw last week the larger market conditions. We're seeing it in slow motion, it almost seems. Let's go back really quick to ApeCoin again. For crypto traders, and I know there's a lot of people who are just exclusive crypto traders doing harmonic patterns, your strategies, your approach has to be the same. If we're not going to aggressively manage, you're not going to capture these moves. And I would say it's either going to take a limit order where we outlined this breakout last week. Okay, where right at the 886 or even just shy of that, so you make sure you get filled, you're out of the position. And then look, we're all the way back down. The breakout we talked about was a 16. We went to the 886, we flirted with 27, 28, and then just right back down. Right back down to where you were for, to see that whole 70, 80% move just be given back. That is going to continue. That's not going to stop. We're seeing a number of different markets express this same kind of situation. Uh, if you're looking for some kind of major crypto thing, well, here we are in May. So happy May, by the way. Welcome to the new month of yet, somewhat of a challenging year. We're not seeing much. It's a malaise. It's the only way to describe these market conditions is a market malaise that at best will be range bound. I think for crypto, total crypto market cap index, Bitcoin, the best thing you can hope for is to hold its head for maybe the summer and come back up to 2.09 or something. We need serious development here. And even if it went sideways between 1.7 and say even just 2 and did nothing, you need it to hold these lows, hold its head here, and develop something else, develop another leg. The larger market is not doing this. The larger market is where I think we have to kind of jump over there and take a look at what just quick view on what happened Friday. And even more so than, say, the NASDAQ, I want to pay attention to what's going on in the Dow. So we do have, I mentioned this last week, we had a bat pattern that developed. It was kind of a delayed, fell just shy. I mentioned this where we fell just shy of that 886. Basically from the February peak down to that corrective low in March. We came back up and hit a lot of resistance at this 354, which is the 886. And now we're back down. And we're forming a bat. That's what you see this blue structural illustration is. So at least you have a formation, but there is not, there's really not much happening yet. Look at the way this is coming off the bat pattern as well. Folks, just it's going to go lower until we can definitively establish some kind of confirmation, some kind of individual price reversal. Can you come down and retest the March lows and stabilize here and get a 3-day move? No, actually, this is something I've mentioned before. It's a real simple technique, standard technical analysis of looking at 3-bar ranges. Well, the last 3-bar range that's been violated is simply a 3-bar bearish breakdown that happened on Friday. And today, what do? We open up 0 in the pre-market and push to new lows. New lows threatening for below April low. And the only thing we have is the March low. The problem with this is as I've said, you have to kick up. Go to your higher time frame when that happens. And so the only thing that is here is a check back of the weekly HSI. We had an HSI signal. That's what that green arrow is. That's our proprietary harmonic strength index signal. Yes, we do look for a check back to retest that low, which is hitting now, basically 328. But that's not nearly enough to hang my hat on for, again, a few weeks. That would need to check back now this week, probably spend a little bit of time and essentially hold 328. That's 32,800 on the index. And below it, I posted something that said, I think it's going to break down. I personally think it's going to break down. I think I said this 2 weeks ago that the Friday close was about as bad as you could be. and that was really it was this candle. This is weekly, and it's the same. It's actually more dramatic even on the S&P 500, and it looks like this. That this one nasty bearish engulfing it's technically okay, it's not an engulfing because the whole body of the candle is not the open did not start above the extreme 3-bar high, but it is one nasty continuation bleeding candle that has had 3 weeks of downside follow through. The chances are these lows get taken out, and you don't I don't want to be in this. I really don't want to be a part of this at this technical space because we are, this is really at a point where you're setting up for the next leg lower. And I have mentioned what is the bear market scenario? It's under these lows. It is under the March lows, and because there's no formation. And now what is at stake? The only thing at stake, folks, is a major retracement of the COVID rally, which more and more to me looks like fluff. 50% retracement puts you at 275. 275. I'm thinking 20, 15, 20% lower from current levels when we break down. And then your full 886. Very well, some major development could take shape. And I have said this is going to take months. Could take most of the next 6 months or more. Into the fall, your 886 is down to essentially 200 on the ETF. That's 20,000. A couple questions. Appreciate it. Uh, Scotty, what's up? How are you? Do I think the lows continue because of the overall trend? I think the lows continue because we had no development off of that peak. In the SPY, we did. Um, but as we see, there's nothing but air. And we go and do some kind of BAM formation. Now, let's connect some dots. What a bat action magnet move, meaning if this is, let's say the March low is actually a B point. Let's say it's a B point, which I think it is. March low is a B point. Where is the 886? Well, let's look at the prior low from your October 20 low. Why? Because we probably can get a B point that's pretty close, about 45%, 44%. That would give me enough where if that is your B point, then what's a minimum 886 swing? 272 on the Dow ETF. That puts you 27,200. And I would even think you have not a little one, you have a large gap there. Large gap. That was, I think that was the post-election bump. That'll come back. And if it lines up with this 50, and I'll tell you what, we saw it in Ape Coin, and it doesn't matter. It's just the same dynamics on the downside as you saw in Ape Coin, and this could be a swift flush once it begins, but chances are it's already started. The chances are that I personally, the 886 off of the recent March swing, once that fails, and I think it fails this week, starts the process. And you're going to see massive 500, 700 point rallies as we saw last week. But it's, Thursday was up. I tweeted this on Thursday. Let's go. Where were we? Where was it? I'll have to pop it up. I tweeted this on Thursday about, well, not only the targets. some pretty dramatic lower targets, which essentially line up with what I'm saying here. Uh, but just, mm, yeah, here it was on the 29th. It was on Friday. Okay. It was up 700 on Thursday. And then when I tweeted it, it was down 600, and I already didn't like it. Ended up being down 900 and change. This is the Dow. And the Dow has been the last to go. This, I will say this, a few thoughts, okay? This rollover, this topping action, what's going on currently, and also the disparity between, say, Dow and Nasdaq, where Nasdaq's not getting hit as much. Oh, sorry, the Dow's not getting hit as much. This is really reminiscent of, say, the 2000 bear market. More and more. Doesn't look like a 2008. It looks like a 2000 correction where Nasdaq takes the brunt, or a disproportionate loss. I don't, you know, I just do not like the position of all of this, and even in, let's say I'm absolutely wrong. Let's say I've got this whole thing wrong. Something comes out of nowhere, and we're starting a new bull market off of that HSI test, which I don't think is the case. I still say at best you go sideways all summer long. You'll have some short term rallies in between, but folks, committing new long term capital at a point like this is dangerous because you get the flush down, and even from a technical perspective, okay, just this simple capitulation move of some kind of massive threatening corrective move down still has yet to happen. If we were in the midst of a 3, 4, 5 week crash and get down to these levels, yeah, we would trigger some uh, oversold readings. Our weekly HSI here on the Dow seems like it wants to take a dip. And again, when you're this close to HSI, you don't fight it. It would still take 2 or 3 weeks to, if it was going to happen this week and reverse next week, you're still talking about a lot of time for this to go lower, take out the lows. That's where you are. Let's look at the S&P 500. And I think the SPY is probably the best way to go with this. Let's get that up. Let's do it this way. So just be prepared for this, folks. Be prepared for this kind of action. I don't. I have to call it the way I see it, and I think after the last 2 Fridays, I don't need to see any more. Here's the SPY. As you see, we've already traced out what is potentially going to end up being some kind of shark with extreme harmonic impulse. What's the key? Off of that October low to that January peak, I want to see a minimum 1618 on the SPY. Takes you under 400. That's well under 4,000. And I have to note, we are cracking March lows as we speak. We're 4,100 on the index, 410 on the ETF. Sorry. And we have no measurable levels being tested. So it's just nothing there. And the 1618 is not defining our shark the way we want to see it. I mean, a 1618 with an 886, well, you don't really have, you can't really grab off of the same points as the Dow. If you do, your 886 is lower. And all of these, at a minimum, seem to want to do a 1 year. Go back 1 year. Give me an 886 retracement. Would not be a biggie. It's just the thing had moved so far in a short period of time with zero corrective action. So that makes this whole range Still, COVID low up to the January peak. This whole thing is at stake, and it's probably going to happen where you have kind of like a fall through the floor moment, which is literally could be today, tomorrow to start that process. Um, Try to bounce this thing off of 4100. Go ahead. Minute you crack 4100, I'll go with a 50% correction minimum of the COVID move down to 335. That's 33.5 on the index. It's 3300, 3350 on the index. But more and more, um, let's just be mindful that the COVID full reset, 886, that's what that means. It's a full reset is kind of a term I've been throwing out for a while. It just kind of tries to describe the natural process of really weak rallies that they can go up and then come all the way back down. We saw that in ApeCoin. I think ApeCoin actually exemplifies the kind of fluff moves that can happen. And trading, it has you have to recognize the fact that just because you're going up for a long time or a while doesn't mean it gets sustained. I just don't. I've seen these things come down the backside of the mountain, and when they do, the whole left side of the chart, when you have nothing but air, no levels of really no levels of support here until we can establish, you know, go down, maybe establish the prior low at 2021 or October 20. Those are the only 2 points to grab off of, which makes this COVID run not only done, but super weak. I mean, I can't, I really can't underestimate how weak. And then if we draw back, which was the thought a few weeks ago of saying, for the easiest thing to look at with long-term market moves is just trend lines. They respect trend lines. All of that comes back down where your true value is going to be, I think, back at 886 full reset. Unfortunately, that reset puts you well into the 2000s. How is that possible? We're trading 4100 now. Seems like a quite a ways away. But remember, your 382 move is 3780. There's nothing here. That's a minimum, and then you bring it back 2500 on the S&P, folks. We're gonna know how fast that happens. I just, mm, it is really not a pretty picture, and it's accelerating. It's not. You're getting closer and closer to the reality. That's the way to think about it. Let's look at the QQQ. I think these ETFs are really good to do so. To look at it this way because um, it's a clearer picture. We can look at the indices. We can look at the futures. But looking at the stocks, I really want to define the levels and say, okay, are we getting a 50% retracement of the COVID move, or is this full reset time? And now here we have QQQ at 312, the 1618, about to get clipped probably in this week. It's going to get hit this week. We're going to break new lows. We already broke new lows on the for the year. That's the other thing to consider. Are we continuing to make new lows for the year? And as you do, that is just pure technical damage. Pure technical damage in a major way when people are looking for a lifeline. This market is trying to look for places where it could stabilize, and It's more of a clear out move. Let's say we could get on the cues some kind of M formation off the top. Forget about that 1618. Maybe we could get some kind of ABCD lower. Still doesn't match up with anything. It really doesn't. This is one of these situations, folks, where I want to kind of enforce it, reinforce and emphasize the concept where it can be confounding. It can be you're kind of we're drawing our M's and our W's, we're connecting dots with the ratios, with the harmonicity of each move, a 50% related to an 886, that kind of logic where when you connect dots and you say, where can that go? And what are even the minimums? And your minimums are far off. It's no joke. It is what you're interpreting. It is what you're seeing. You let the mathematics dictate the framework for the analysis, and you don't care if it doesn't materialize because chances are it will. And if you miss anything, well, guess what? You just stayed out of trouble. But at least you have a really clear idea what the harmonic thing is going to do. And I don't like it. You got to look at the COVID versus 2000. There's the COVID move, folks. From 2000 up to, sorry, 175 to 400 on the cues. I want to show, let's go back to early 2000s. It's kind of like this. Now the cues, and this is probably good for S&P and the Dow, but as I said, I think this is more a 2000 move. Not quite the same, but it's the range of what happened here. Pretty much, it seems to be shaping up in the same regard. The triple Q is actually our relatively new invention, 20 years old, where they came out right before the big run. It's one of the reasons why we did see that run. The other reason was the Y2K run. But you had a massive move up, and then you did get a kind of a crash move down. But this is more of the action that I want to look at, where you're breaking lows, you're breaking lows, you're breaking lows, and you say to yourself, it is full reset material, and that would be my minimum projection, followed by say a 382 and a retest. That's how we would think about it. But when we get there, and you get down to your 886, which is again there, you do nothing. I mean, you keep sliding and sliding and sliding, which could be the longer term scenario here, where you go into a believe it or not, a two-year bear market. I mean, 128 weeks to the low, high to low. A lot of similarities, and the technical damage of that side has not begun yet. So it was 131 weeks, roughly 130 weeks, and it was a complete retracement of call that the IPO of the QQQ. And I'll deal with the excessive overspill, meaning you get to the 886 and you keep going. We'll deal with that later. I want to get from, and remember, we're not even 382 yet. 382, imagine it's at 90 after being at 120, and your 886 is basically 50, saying you still need a 40% haircut or more. This is the kind of logic where you're not there yet, and it takes a while to materialize, but you have to follow it, follow the framework, and then build your positions accordingly around that whole condition, that whole situation. Sorry to be the bearer of bad news. We're breaking new lows as we speak. Market's dropping. And I just, folks, we're in that spot. Let's see. Let's go back to the diamonds today. Yeah, down another 200, 220 after being down 9 something, 960. The diamonds fail. Here's your 886 off the March low. The diamonds fail. Your 886 is 325, 325.50. I'm really not worried about that. I'm worried about what happens underneath that because there is nothing but air underneath that. You want hope to goodness this shark can complete and give you at least a temporary pause before a full flush, but doesn't look so. This is certainly a point where we can look at potential flaws, and that's what I wanted to talk to about from a strategic standpoint today of how to understand when you've got a flawed setup. Like this is a shark pattern, potential shark in development, but the way this is coming into that zone, pretty dramatic drop over the last 6 weeks, 8 weeks, actually down 6 of the 8 weeks, and starting off May in ugly fashion. I think this could be down another 500, 600 by the close. Thanks, Ziggy. Ziggy just commented the S&P 500 has broken new lows for the year, folks. Get ready for the flush. One other thing I wanted to bring up that I have to update because we spent some time on it last week. Look, the 2-year, the 10-year, these did not reverse. If anything, we were looking at the 10-year. Let me show you this. All right. We talked about terminal bar, and we were terminal bar +1 last week. And what happened? Well, we had a bearish candle on Thursday, was it? It was either Tuesday or Thursday. We were early in the week, and then it came right back and checked back to the terminal bar, closed higher, rates popping. Again, this is a chart of the 10-year yield. Prices lower, rates higher. You're now at 3%. But more important than any of that, and let's always bring it back to the harmonic framework. You can talk statistics all you want. You can talk political jive. I don't care. What do we know about the harmonic framework? That's your terminal bar of the weekly bat. And we have a +1, +2, going higher, going higher. No confirmation. How do we read it? The whole zone is at stake, meaning this bat pattern probably is going to take the better part of another 3 to 5 weeks and go up because of that failure or that failure to reverse. And certainly until you get some kind of massive, clear inflection reversal out of the zones. I mean, look at your amplified. There's amplified RSI, folks. Read that like temperature gauge, if you will. It's still hot. If anything, on that 10-year yield on the weekly reading, we failed that prior high, and then you're doing kind of a stalled expansion in the overbought, which always says more time. And when that goes on, you're going to go to the upper side of the zone. 366, and probably even more dramatic is the 2-year, because if the short-term rates spike, you're done. Short-term rate spike, it's not going to be a pretty picture. This inversion gets nastier. Here's the 2 year. Yeah, 2 years. A 2 year, actually, you're amplified. Look at what this amplified is doing up here on the weekly chart. We have been in the overbought condition since last September. Rates on the 10 year were less than 0.5%. I mean, essentially, they went to zero anyway. But then this expansion, you go to all-time highs and stay up here. You're staying up here, not weeks, months, is remarkable strength. It will take many more weeks until you can even say that that's going to roll over and chill out. And there you go in the 2 year. You're about to go well above those 18 highs. And as we mentioned before, the only thing looking left is about a 12-year, 15-year 886 retracement. This is where harmonics are going to come in and give you the picture long before it materializes. It's something like this. Because that's the all-time low, folks. And that's your 886. 4.68. 4.68 on the 2 year. And that still won't even be anywhere near the stated inflation rate. Let's connect some dots. And we need to go monthly. Let's put it all up. What's going on? This kind of reminds me of the natural gas chart. Long before nat gas really got going. And this is why I think nat gas is going to well above 10, probably 15. We'll look at that probably tomorrow. But what is really here, if we connect dots, because this secondary low is below that low, which makes this what? A shark. A shark on the 2 year yield, where we're going to get a 1618 off of that secondary low and basically retest the X point, the 2007 peak. Again, I think the 10-year yield is on its way to go to about 5.2. You're at 2.7. That's why when you see this kind of stuff come together and you simply connect the ratio dots of what is possible here, it's in a bad spot. It's in a bad spot. I don't even know how to emphasize how bad of a spot it is. Bad only if you are on the opposite side of it. So this is the other consideration that you know, we're not I'm not trying to play one side or the other. We don't have to be long. In fact, if you're always looking long, then you're going to run into these times where the market's going to go through natural corrections, natural corrective phases. And this is one of them. Even if I was to go off of, say, this last pattern that we could actually identify, which is 4.45%, this prior hop level, and that matters. It's interesting there's no other pattern showing here on the monthly, but you did have one up at the hop level. It was respected. 4.5%. Sorry, but that kind of move will get you to your lower levels. Beyond that, you know, I think it changes the game. Where is all the money going, in your opinion? It's a great question, Ziggy. I think all the money is simply going to vacate. It's going to go to safety, and I think it's going to go to essentially protecting from what I think will be a massive debt default situation. Many companies cannot afford these rates. They can't even afford 2.7. Okay, and there's a lot of companies that are stretched that they're not going to be able to refinance at 5 or 4 or 3, and we're talking 2 year time frame. It's going to go to cash. It's going to go to real estate. You're going to hear a lot of people talking about land banking. What does that mean? It means they're just going to pile their cash into real estate, which they're doing, which is happening, and they're not gonna care because take a 50% hit in the market or take a 20% hit in real estate. Who knows? It doesn't add up. It's not you don't just stop at this level, especially after doing what it did off of this bat pattern on the 10 year. 10 year yield actually better than the 2 year for longer term, obviously, for longer term considerations. But if you want to know if people are really going to try to put money away in the 10 year, there you go. Go to the weekly. Let me get back here. There you go. The 10 year yield has basically supplanted the 30 year as your long term bond investment vehicle. But this acceleration, this is where we're going to threaten a breakout, actually. You're going to come back and retest that X point on the bat. And again, psychological 3% level, that will become a floor soon. What do we know about harmonic patterns is we have a hop level at 366. And oh, look, we are getting a blue deep crab, but all of that's still higher and it has to do a lot of work before I could even consider it. So you're in a point where you go immediately from 3 to say 320, 340, 360. Pete's asking, where will the money come from to keep anything up? It's not. The money's done. That phase is over. That QE thing is over because we're seeing the material move in rates. I would have to say that moved down to basically 0.5% on the 10 year. Total joke that people are now getting out of bonds. They've been doing, there's been a lot of sophisticated trading strategies that just hedge these really super narrow margins. Okay. But if a freight train is coming where people are dumping bonds and they know that yields will be substantially higher in 3 to 6 months, they're not going to be locking much up on the 10 year yield. They're going to let that fly. And the money, look, where the money will come, it will only come after the devastation. And we're seeing that. This is where the malaise gets nasty, folks. I've been talking about this malaise. It's not only here, it's now entered a new phase. And it entered that new phase basically a week ago Friday, sealed the deal, nail in the coffin, talk to me by October. I mean, this is going to be not the summer of love for the Bulls, and it by any stretch of the imagination. And if this gets out of control, again, we're here in a really nice zone, acting super strong. Look at just this year. How many weeks up in the last? We're up. I'd have to say 8, 9 weeks in a row. And if you start from the 2020 this year's low, basically a 1.4, then your yield doubles within the first 4 months of the year. Yeah, that's people are they're not responding, Pete. Um, and they're not going to bring new money. They're trying to protect their ass. They're trying to protect what is to come, which is, hey, I'm a massive tech company and I need to refinance $10 billion to keep my operations going, and that's about all of them. That's how they get those valuations, and they know they're going to pay double in a short term, in pretty much any term. You're talking about you're paying double over a year ago, and not to mention your credit quality and your credit standards are going to have to go up majorly because get ready for credit default. Get ready for major defaults, and that's what happens when you run interest rates the way you do, the way they have done. You have to pay the piper. That's what the market's all about, and you don't want to get caught in a as a bag holder, which these people are going to, these hedge funds, and unfortunately, a lot of the 401k people are going to get hit. They're going to get hit, and I mean where you're going to go from a year ago, year and a half ago, to where you go and you're looking at your IRA, you're looking at your 401k, thinking it's real great, and then in a short period of time, it's a third, a third less, 40% less than it was at its peak. I'll tell you, I'll tell you guys, here's a story, okay? So I did a 529 for my son, and I fully financed it, fully funded it. A 529 is a education fund, and I did that a year ago or so, and now it looks terrible. And I'm concerned that thing is gonna basically take a 40% haircut. Don't care if it's tax free. It's in the wrong spot. It's basically S&P indexed, and I don't like watching that thing go down every day. I wasn't going to touch it, but if I'm right about what I'm seeing and the market's going to do a big flush, well, I have to reconsider it all. I want to look at a couple more and get out of here. Here's Facebook, Meta platforms. Okay. You see on the weekly, we've got this crab pattern. It's one of the stocks I'm watching because I think once that fails, two of the five FANG or two of the four, depending on what you're doing, are going to be dead. And I mentioned this before. We know Netflix is dead. Netflix is done. Do not mess with Netflix unless you want to go on the downside. And a guy like Bill Ackman lost a couple $100 billion in a very short period of time on Netflix because that broke down. I do think Meta Platforms is the next one to go. Recall this one, and it goes back to a lot of similarities of the themes that were happening in the 2000 bear market, or the dot-com bubble. Maybe what we should start calling this market is the COVID bubble. Maybe that's right, because it is a COVID bubble. The COVID bubble was a great market, but it's over. And now, take a look. Netflix, poster child for what is going to happen. And I want everyone to go do your measurements. Look at all of these IPOs of the last 10 years, 15 years. It includes Meta, it includes basically all of them, Google, everything. But Netflix is just ugly. And a full reset, 886, 88 bucks all time. 886 is at 88 bucks. And that's where she's going. Trading 194 now, but this will go through a lot of zigzags. You'll have, sure, you'll get one or two 5%, 10% days up in this corrective rally, but this has already been flawed. This whole chart and the whole progress of that trend, just to show you, was flawed essentially here. Connect some dots. Shark pattern at an 886, 275, 277. You're down past the 1.0 straight through. When that doesn't hold and those clear connect the dot structures, which Netflix is, just fails deliberately. It's telling you that the whole move down has a lot more to go. That pattern's failed. No, thank you. No, thank you. Yeah, let's call it the COVID bubble, folks. Hey, I talked about Bitcoin already. Check out the earlier comments. Bitcoin. Well, I talked about total crypto. Bitcoin's going to be a drag. Bitcoin's going to be a sideways grind for all summer long. At least you haven't failed yet. But, you know, everyone's maybe piling into Bitcoin, but we'll have to keep our close eye on that, especially total crypto market cap. Let's look at gold. Gold's getting clocked because of the rate debacle. The malaise in rates is really affecting gold now. And again, the pause that we saw, the massive move up to basically 2000. Let me clean this chart up. Went up to the 886. We failed to progress through, and we're now taking a punch. Check it out. It's off of that crab pattern. Remember the crab? All right, still a type 1. Target 2 is 831. That's where she goes. 831 is your target 2 off of that high, and gold is going to be in a long pause phase, folks. Gold's probably going to be a safety vehicle for a while, and probably where people just throw money into it no matter what to limit the downside. They might be willing to lose. There's another area where people would be willing to lose 10, 15% versus 40% in the market. If we're looking at the pattern, well, came all the way down in 1925, and I was looking for the return. It didn't materialize. We actually ran right into that HSI. That's not a good sign for me. I look at that as saying, okay, go 30 bars, 30 more bars, and then target 2. And that's not relatively not so bad as other markets, especially during this time. If we get this spike in rates that I'm looking for, okay, and you might do a longer pause down there at that target 2. But let me tell you again, the return phase of that crab pattern won't start for at least until at least that 30 bar week a daily time frame, daily since that last trigger has been registered, or 1831, whichever comes first. And it will take time. Again, this summer, folks. Jeez. Here is nat gas. So NG is one of the few, okay, doing the return in the way that we want to see it. 635 at target 1. This is a daily chart. You're up again another 20 cents today. Nat gas wants 916 to the hop. Let's see how it comes together, because look, a few things on the amplified chart that are super strong. Amplified RSI on the daily, on that last correction, came down to a 50 level and has returned. Not to mention, let's connect some dots on the indicator, because we can do this too. We can just to get it to gauge potentially where the indicator reading can go, because we know these when these W formations take shape, even in the indicator, They're quite strong. Early leading indicator in terms of how the readings can express themselves. But something like that, where we take some kind of bat formation and go back up into the extreme, retest the 886 of the prior reading in that time. And clearly, if this is, think of it this way, let's just look at the reading, the formation of the readings. Draw your W, okay? Here's your midpoint at B, and you're already breaking out. You take the BAM effect, and we get some kind of push up, back up into the extreme, where that just says this continues higher until you hit those other levels on a retest and register an overbought reading. So you're trading 749 on that gas. Our XA retest level is 797, 798. These are minimums, and they're higher, 5%, 7% higher minimum moves until we could even consider that a full retest of the type 2. My guess is we get another spike. We get some kind of big spike to 960, 916, sorry. Scotty's saying last time inflation was this high, there's a comment here, was the 90s? No. Last time the inflation was this high, it was early 80s. Another big announcement that will come out. Does anyone know exactly when that inflation announcement's going to be? The monthly inflation rate? It's pretty soon, right? Remember, we're at 850. And I did say that this is, if we're going to connect dots and look at inflation, look, this is remarkable. This is why we have to go left. 8.5%. Last time was 81. Was I in high school? No, I wasn't even in high school yet. But this is the scenario for inflation. And I've done this before. I posted it. Again, let's connect dots harmonically. It's a shark pattern. 886 goes to about 13% inflation. So when we get up there to 13% inflation on inflation reading, maybe this month will be 9, next month will be 10, and you get yourself to about 13, 14 by September. Also, if we were reading this indicator in the same way we do with all trending readings, well, not only is that above, it's you're breaking out, on amplified RSI on the weekly level to this century's highs. Highs for the century, for the 21st century. Yep, we haven't been higher. And you're still only 8.5%. That's a strong relative reading, folks. Again, it's not that I want to, it's not that I'm trying to like gang up on one side or the other. I am this relative position of the market. And when I connect dots, it's just, I have to walk through. It's a process that I go through. And the patterns define the framework no matter what. And then I kind of spell it out to myself. That's what I recommend everyone does. Learn the framework. Get with the software. Okay, wait, I got to do this. Okay, everyone, please get with the software. Go to harmonictrader.com, become a basic member. And I'm going to say this. I think everyone needs 2 programs. You need the TradingView program. I've received a lot of requests. I think everyone should get the TradingView program. Why? Because everyone can access it. You've got access to amazing data feeds, and I think it's the easiest one to access. But then Get with one of the pro platforms, especially for people that are active traders. When I get back, we're going to be doing a lot of stock trading on 4 hour and 1 hour charts, day trading. That's all this market is, just a day trading speculation vehicle in a major downtrend. Get used to it. But get your books. Get the books, watch the webinars, and join the Discord. I had to do that. Go to harmonictrader.com. It's where it all starts. And then follow me on Twitter because that's where I post probably some of my, probably the best charts and little comments. And Warren Buffett and Charlie Munger need to go sit down. Oh, Charlie Muffet. Charlie Muffet. Charlie Muffet. That's great. That basically describes those two clowns. Yeah, they're billionaire clowns, both of those guys. Don't want to get into it. I did want to show something, probably one of the strongest stocks I've owned. I took profits, and I want everyone to start taking profits. When I see stuff like this, Altria Group, this is probably one of my favorite forever stocks. There are stocks that you can own forever at the right price. Altria is one of them my whole career. I still own a chunk, but I sold some because after this massive bat pattern we talked about back in November, we ran right into the hop last week. We retested at 56.22. We're down 54.91. What is it? It's a type 1 correction. 49.59, folks. I will look to add back that position down here. But if Altria is doing that, few others are doing this as well. Some of the stronger stocks, Coca-Cola. Look at Coke now. How's that for you? We talked about Coke basically hitting the 1618 up here after earnings, and then they sell it after earnings. Look, when these stocks roll over, which are usually the last ones to go, they will give you sizable corrections, and I think Coca-Cola could come all the way back down to this 52 range. Coca-Cola, another forever stock at the right price. Look at the weekly, look at the monthly. Buy 10 shares, buy 50 shares if you can, 100 shares, and hold on to it, but at the right price. There's your all-time chart on it. Coca-Cola trying to break out. It did break out, but no follow through, and we have a bunch of patterns here. If I'm bearish on Coke and I'm bearish on Altria, I'm probably bearish on the whole market. Yeah, you're right. Ziggy Hershey's, my man. Hershey's, come get your chocolate bar. Although peanut M&Ms and Reese's peanut butter cups are some of my favorite. Eesh. 216. Wow. But look at this. Just another one rolling over after earnings. Daily, wasn't it a weekly? There was a pattern here. I think there was a crab here on the weekly. Yes, sir. Hershey's. Love the stock, love the company. Hershey's, Pennsylvania, if you've ever been there. Or if you haven't been there, you can go there. It's a really cool place, great amusement park. Take the kids, sell the stock. Sell the stock, take the kids to the park because you go to 167. Take your profits. Maybe we buy puts. I know put call ratio is ridiculously high, and those are some things I want to talk about later in the week. But when we've got patterns like that weekly, look at that beautiful thing. You can't deny it. And if you're a chocolate lover, you still have to admit, harmonic pattern, what's that telling you? This massive, massive breakout, this correction into the COVID low, and then you broke out, took you to the 1618, and then we registered HSI on the weekly. That's good for a sizable 30% correction down to, again, target 1 at a minimum. This is where your minimums, even if we go for the minimum target level and we don't get all the way down there, we know this direction has changed. Even if you come back into the zone, you're still talking 10 to 15% lower from current levels. Another great question. Thank you, Duff. Duff is asking, wouldn't currency markets be a great vehicle to be trading? I think so, but the currency markets, mostly because of the Fed action over the last 13 years, has slowly killed that volatility. And I have not traded currency markets since last year, and I really tailed off that trading in recent years to where I just think it has not yielded great moves like we're seeing here. For example, okay, Hershey's has done a 3 bar reversal today. Check it out. 3 week reversal. Sorry, it's done the 3 bar. And this is a critical development in the reversal phase. Here's the completion. And it's good to walk through this. Look at the terminal bar all the way back here. All right. That pattern hit the 1618 back in January 3rd to be exact. But where was the first bearish candle? Didn't come in until the end of the month. Any follow through? No. And we grind higher. And there's no confirmation. When you see that kind of action, we saw that, and I outlined that in the 10-year bond. You're likely gonna run as high as the hop level. In this case, confirmation didn't come in until 12 points above the hop. But now that it did, like a light switch, bang, it goes on. Not to mention, it goes on in an ever shrinking range. 1, 2, 3 bars, flush, goodbye, trading 216. Okay, it's down big today, but let me tell you, let's get an eye on this thing because there's nothing but a flush to come back minimum under 200, maybe some 200 puts. Those premiums are probably a little steep today, but this is just getting started. So we'll look for these, and they're going to be boring. That's the other consideration. We're used to multi-baggers, as Peter Lynch would say. 5 baggers, 3 baggers. We want to go for maybe 0.5 baggers or 0.3 baggers. Or if we're going to deal with put options, maybe you're buying some puts for $1 and you sell them for 3. But as we've seen in the ape coins of the world, these moves are going to be fast. They're going to be hard. They're going to require limit order targets to get out. And then you look for the next setup because we're just trying to shoot the segments. Yeah. Duff, another good comment. You think the major capital flows will be looking to move sovereign bonds, which should drive some new volatility into FX. It's not a bad thought. That's actually a good kind of conceptual. What Duff is saying here is a good comment. It's basically saying that money will try to go into, say, hard currency economies like the Canadian dollar, which I think Canadian dollar is probably a great one to be into for a lot of fundamental reasons, or Brazilian dollar. Exactly. I've said this about the Brazilian dollar. Brazilian dollar is probably going to be an amazing investment over the next 5 years. But not many people know about that stuff. Most of them are going to try to save their butts when this market really accelerates lower, which it is. So let's come back to that and wrap up for today. Let's go back to where we started today. Diamonds, down 250. I don't care what happens today. I don't care if we get a bounce. This is what we need to do going forward. Pull up your 5-minute charts, folks. Trade the 5-minute swings on futures or diamonds or weekly options. Weekly put call options, not a bad way to go. Let's see this hourly chart. There you go. Look, the hourly charts have been major opportunities, and this current hourly situation for the diamonds, the next pivot point is this hop level down around 315. And this is going to stair step down in the same way it's stair step up and sideways. I expect a reaction off of these lows, but then we'll probably, where's the acceleration going to happen? Maybe a relief rally, but folks, once we dump that out, anything under 32,000 for the Dow, under 4,000 for the S&P, under 12,800 for the Nasdaq 100, that's where your major failures occur. Beyond that, I'm just interested in 5-minute day trades and 1 hour weekly swings. Here's CVX. This has been a real good one. I told everybody I cleared out of that. It took profits up at 171. It was a beautiful, beautiful ride. You bounced off of that hop level at 152, but look, we're just forming pattern to pattern to pattern. This is why I firmly just cannot stress enough why you need the software. You could be spending your days trying to trace out formations and still not knowing if it's right, or just following what the software is giving you. And for CVX here, our next opportunity is probably to the upside to complete that crab pattern and then be a sell, be another sell. I'll talk about this tomorrow. I'll get into oil. Let's do a little more natural gas and we'll do some more crypto. But for now, folks, please read these signs. Review what I've been saying for the last few weeks. And then let's see how we shape up by Friday. But this is another bad week, another bad start to another bear trend week. So appreciate it. Thank you to everybody. Thanks for the great comments. Bring those other markets tomorrow. We'll get into them about the same time, same channel. Until then, folks, thanks. Have a great one. Go get them. We'll catch you tomorrow.